we need to be conversant with the fact that no investment vehicle is risk-free. Every investment has a level of risk attached to it. Even holding cash itself is risky to some extent. There's inflation risk, and there's even risk of of thefts. And so, in this context, I want to discuss the disadvantages of investing in corporate bonds. In the corporate bonds, you have advantages. They equally have disadvantages we should take into consideration as we have that particular desire of eventually investing in them. Number one disadvantage here is credit risk. When it comes to credit risk, corporate bonds carry the risk that the issuing company may default on interest payment or even fail to repay the principal at maturity. That risk is always there, and especially for low-grade bonds like junk bonds. You may end up losing your capital, as a result of the company not doing as well as they expect to do. And so it's always very risky. Though they come with a higher interest rate, higher coupon rate, but the risk is so pronounced when it comes to investment in junk bond or in high yield bonds. Number two is interest rate risk. You discover that like all fixed income securities, corporate bonds are not exempted from interest rate risk. In other words, there's that inverse correlation between bond yield and interest rates, fluctuation. When interest rates, rises, it would cause bond price to fall, and when interest rates fall, bond prices will invariably, rise as a result. So that particular risk of attachments or of influence from interest rate fluctuation is a very huge disadvantage when it comes to investing in corporate bonds. And we should not forget number three, inflation risk. The fixed interest payments that these companies provide on their bonds may not really keep pace with inflation. Sometimes the interest coming in may not really have sufficient buying power to be able to cope with the rate of inflation in the economy. And so there's that, risk of inflation eating up the buying power of the interest or the coupon whenever it comes in. Number four is lower liquidity. Actually, corporate bonds may not really have sufficient liquidity like, let's say, a typical stock investment. Sometimes you may want to discount your bond, may want to sell your bond before maturity. You discover that that particular liquidity may not be there. If you look at a typical trading apps and you want to trade bonds, and you go to you pick a given bond, you discover that you may come across buyers, and you may not equally see sellers. You may come across sellers are lined up and there are no buyers. So that issue of liquidity is a typical disadvantage someone should take into consideration when you are investing in bonds. You may not really get your money as easy as you want to get it back if you need to sell before the maturity date elapses. Number five is taxable income. The interest income from corporate bonds are subject to both federal tax, state tax, as well as local government tax, which can reduce the overall returns from returns an investor can get from investing in corporate bonds. The level of taxation is somewhat on the high side. That's what we must take into consideration if you really want to invest in corporate bonds. It's not a tax free. It's not like it's not tax friendly at all. And number six is default risk. That is particularly for high yield bond. High yield or jump bonds. Of these particular bonds, they offer a higher amounts as coupon, as interest. But you should not forget the fact that the risk is always there. This higher interest is there to compensate for the risk you are taking in investing in companies that are not really sound financially. And so the default rates compared to government bond or municipal bonds is quite high. They pose a higher rate of loss, and so we should not disregard this particular risk attached to investment in corporate bonds. Number seven is callable bonds. Some corporate bonds are callable, meaning the issuer can can call back this bond, so to say, before the maturity date. Let's say, for instance, a bond is slated to mature in 5 years. Maybe in the year 2 or year 3, the issuer may decide to call back kind of this bond. So that bond is callable, and normally it is done to to favor the issuer, not even the investor, because you may end up having to reinvest, under unattractive circumstances. You understand? So these are an element of risks you must take into consideration. And not only that, we have these are event risk. Corporate bonds are subject to event risks such as mergers, such as acquisition, and even spin-offs and restructuring, which can negatively impact bond value or the issuer's ability to make payment as at when due. These are all event risk. You understand? And so when it comes to merger, acquisition, spin-off, restructuring, they affect bonds mostly negatively most at times. Please like this video and subscribe to this channel. It will really motivate me to keep on bringing content of this nature to you. Number 9 is covenant risk. Corporate bonds may have covenants. These are clauses that would kind of compel the company not to take on additional debts, so as to be able to have the capacity to pay back, the principal, and the interest as at when due. So if these covenants are breached, bondholders may have limited recourse to protect their investments. Whenever the company decides to go against these covenants, there's nothing much you can do as a bondholder. And so we must always consider covenant risk. Number 10 is volatility. That's particularly common to high yield bonds, junk bonds. So high yield bonds, corporate bonds, can experience greater price volatility due to changes in market conditions, company performance, investors' expectation, market sentiments, which can result in a kind of larger than normal fluctuation, in the par value or in the market value of these bonds. These disadvantages make corporate bonds a less appealing option for investors, seeking low risk, stable returns, especially those considering lower rated or high yield bonds, which tend to carry a higher level of risk. So these are things we must consider before we go ahead and invest in the bonds of any corporation, bonds of any company. Take this into consideration. Is the company doing very well? Is there any risk of default? If you feel you can really stomach the risk attached, you can go ahead and invest in corporate bonds.